Thank you very much. I'm excited to be here, excited to be with this group. This is just like your board meetings, right? I get to interview a lot of these people that are here at the table, but never together, never in a group of 12, and never in Riyadh. So thrilled to be here. Thank you for having me. You know, we are lucky at this table to have basically a good chunk of the global financial services industry here, and a good representation of the world by region, private versus public. So I'm looking forward to a good conversation about both the short-term outlook for the economies and from where you all sit, and then if we have time, and we'll keep our answers brief, the long-term outlook and some of the structural, secular changes that we're all going through. So Ron, maybe I'll start with you and the sort of global outlook. You operate in more than 100 countries, right, and have trillions of assets under custody and management. Global economy right now feels a little bit lopsided. How do you see it?
Well, Sarah, I think that the good news is that at this time last year, there were all sorts of prognostications of a global recession, and we've largely avoided that. And I think that's due to some deft policymaking and the fact that we've been able to navigate this up and down in interest rates. But I think in the short term, the big challenge is the lack of global growth. And what growth we do have, to your point, is very lopsided. You see the US doing pretty well in terms of growth, and then it's really hard to find substantial growth everywhere else. If you think about the past 30 years in China and what the kind of growth that we're seeing now out of China, it's just not there. Europe hasn't seen growth now for most of the last 10 years. So I think the biggest challenge that we have in front of us is the fact that there simply isn't enough growth.
From your vantage point, Harvey, at Carlyle, you guys have, what, 300 plus companies in the portfolio all over the world. How do you see it?
Sarah, great to see you. Great to be back in the kingdom. So we roll up the data from all of our portfolio companies, which employ in excess of 1 million people. And I agree with Ron, there's an unevenness in terms of geography, but in aggregate, the activity levels, the performance of companies, the marginal pressure on labor costs, we've all seen this come down. I mean, during the pandemic, we had companies where individual items, let's say a $1 input item with supply chain problems, could be $2 or $3. So we had companies navigating inflationary pressures that were 200-300%, even though aggregate inflation might be 8, 9, or 10%. And so I think we have to give central banks around the world, particularly the Fed, a lot of credit where credit is due, because they navigated this. No one expected to go through a 500 basis point raise and now some reduction in rates. I think in terms of the short term, the challenges in the short term are a little bit the manifestations of what we'll see in the long term. We're dealing with significant deficits and actually strong economic conditions. We're dealing with shifting monetary policy. And I think the big challenge and opportunity set for everyone in this room and globally is the fact that the big paradigms are changing.
Yeah.
The things that shaped the last 30, 40 years of economic activity are shifting, and some of that is extraordinary. But we have heard a lot about energy transition for a number of years, and especially today. But now we have energy net addition that we're also going to have to tackle, and these are multi-generational problems.
And hopefully we'll get into some of the longer-term ones like AI, which I know a lot of you are excited about, and the debt problems, deglobalization. I mean, these are all the big factors. But in the short term, Jane, the U.S. still the bright spot in the world. You're a very global bank.
Yes, and it is truly invigorating being back in the kingdom again for a few days as one of the bright spots. In the US, let's look at the consumer. The consumer is broadly healthy, a tad more discerning than before, and their spending is still growing. But a lot of that is being driven by the affluent consumer. The middle income consumer is probably more mindful about where they're spending, and then the lower income is where we've seen some of the inflation pressures really biting in as wage growth hasn't quite kept up. But to the points we're talking about, a lot of roads do lead to the US at the moment. There's some push and pull factors in that. And I would say, whilst you shouldn't bet against a Saudi entrepreneur, you should certainly never bet against an American one.
Do you think we're, okay, Raise your hand if you think we're going to get 2 more rate cuts this year from the Fed. Anybody? No, you don't think 2 more? The market thinks 2 more. 1 more?
The market thought 7 last year.
1 more this year. And as many as the market thinks next year, David? I don't know.
I mean, next year's a long time from now.
Okay.
When you're talking about interest rate cuts. And I think Harvey just made the point that's the right point. The market thought that there'd be 7 cuts this year. I think it's hard to think about monetary policy in 2025 in the United States until you get through the election and we get a clearer sense
I was going to bring
policy,
that up, of course.
policy actions, because policy will shape monetary policy. I listened to the earlier panel, and one of the comments that I agreed with is that structurally inflation is more embedded in the global economy than the current narrative. That doesn't mean that it's going to rear its head in a particularly ugly way, but I do think there's the potential, depending on policy actions that are taken, that it can be more of a headwind than the current market consensus.
And quickly, I want to ask how the view right now on the capital markets, which you have a really good window into, and investment banking, IPOs, deals, where we are in that cycle, if the economy in the U.S. is so good.
It's interesting because I've actually been talking to my team about just kind of looking back at a market environment like this, where you're still running with M&A and capital markets levels that are below trend. So we've definitely seen an improvement in 2024 versus 2023, a recovery, but we're still running below 10-year averages. So M&A right now is running about 13% below 10-year averages. Equity capital raising is running about 24% below 10-year averages. Now this is versus 25% below 10-year averages and 34% below 10-year averages last year. So it's improving, but there's no reason why capital markets activity shouldn't be running at 10-year averages or even better, given the market cap growth and market cap expansion we've seen over the course of the last 5 years. So I think we're in a recovery period. And my expectation is you'll see more robust capital markets activity in 2025 and 2026.
Do you agree, Ted? You're in that business too. You compete with Goldman.
I do agree with that. I do. We had the sugar high of COVID and 0 rates, so small companies could go public without much of a business plan. And then we had this pretty tough funk for about 18 months when almost nothing was happening. And now it feels like a more normalized cadence. It is tougher being a public company, and the sponsors have done a great job monitoring private companies, so you can do that longer. But I think the process, the slow process of companies going public is at hand. I think they'll be bigger, there'll be more established companies, and that's obviously strategically interesting for other sponsors, but also for big corporates that have been waiting to get together with folks that are in the public market. So I think it's
But 2025 will be better than 2024 capital markets?
Yes, I think so. And not just in the U.S. We're seeing re-equitization in places like Japan and in India, and of course here in the kingdom. So I think it's going to be a global phenomenon, and great for everything that we care about in the broader asset management business, because you have transaction activity like IPOs and M&A, and then the wealth management client base gets interesting. So I think that flywheel is going to get going the middle of next year.
I'll put this to the sort of U.S. CEOs in the panel. Does it matter what happens to the election, to the outlook for 2025 in the U.S. economy, one way or another? Anybody? No one wants to take this, obviously. Mark, come on. Help me out.
For M&A activity, absolutely. Yeah. I think there's an absolute chill on M&A activity as a result of current policy. And I think you'll see it freed up if there's a change in regime. I think you'll see investment liberalization if there's a change in government. But remember,
if Trump wins.
If Trump wins. But we're all talking about in the US of shades of good. We really are talking about shades of good. And to come back to your point on rates, we massively increase rates, and yet stock market at a record high, no unemployment, capital market issuance at will, and we're stimulating the economy. Infrastructure bill of $2 trillion we passed still hasn't been built yet. Semiconductor bill 2 years ago, everything being built. A year ago, Inflation Reduction Act, everything under construction. We're the largest recipient in the US of foreign direct investment 3 years in a row, and we're ramping defense production. Every one of those things is stimulative. And so the notion that we're cutting rates, I'm trying to remember why we're cutting rates. other than to try and equalize the bottom
Inflation's
quartile.
come down a lot.
But we just got through a discussion of structural inflation, and the things we're doing that have not yet come online are also inflating in that way. And it's unclear that you will solve the problems for the bottom quartile, which are job growth, wage growth, given who they're competing with for jobs. So I think things are on hold until the election, but we shall see.
Well, speaking of cutting rates, the rest of the world also has been in rate cutting mode. And, you know, Neil, you heard about China, and that has been a soft spot in the global economy. But you have a pretty good view of Asia in general. So what do you see there?
Yeah, I think actually I feel pretty good. I think at least coming to the second half of this year, because if you look at Asia, where we're focusing on, China's coming back. I think with the recent fiscal and monetary policy, Japan is doing well, giving all the reforms about corporate governance, transparency, etc. We got Indonesia and India, which probably enjoy the highest growth among all the countries in the world. If you look at the large economy. And the kingdom, obviously, is also, catching up all these new industrials in addition to, the traditional oil and gas industry. So I think Asia as a whole continue to be a very strong growth engine. And with China, continue to actually have, one of the very, very big consumer market. Every single large, multinational company still want, have, a exposure to the market, want to penetrate that market.
Your Excellency, clearly this is one of the bright spots that have been invoked. You lead the Islamic Development Bank, so representing 57 members. Maybe you could just give us a view of what you're seeing in the near term challenges and opportunities in the region.
Thank you very much. First, I'm very happy to be here with this group and also to be from this region where there are nice green shoots of growth and development happening. And I think the reason for that is that in spite of the MENA region having suffered over the past 20 years from very negative effects on its economy, leading to a decline in growth down to about 2.1%. Although we hope that if the conflict subsides and the other macroeconomic and structural policies that have been enacted are going to continue to be pressed forward, then actually the MENA region can come back to a 4% growth. The example of the GCC as a whole is a bright spot, I think, in the region and in the global economy. Even though Saudi Arabia last year had a negative growth, but it has rebounded very nicely, thanks to, one, the very serious, predictable monetary stability, and the very serious, unpredictable fiscal policy. I think the counter-cyclicality that has been practiced in Saudi Arabia for a long time has borne fruits and has made the economy a lot more stable and a lot more resilient in spite of all the difficulties that are happening. Thank God the other members of the GCC are also following suit. I think if you take the UAE, there is very robust growth and diversification. Saudi Arabia now, the diversification is going full blast. I think that holds a lot of promise. But of course, we are very well connected with the rest of the world. Our oil prices, oil production, exports and imports are all affected by what happens in the rest of the world. And therefore, we hope that a bit of stability in the world will be needed. I think this region, since the 13th century, has had more than enough of conflicts and difficulties, I think, since the Mongol invasions.
Yeah.
So I think it's about time this region gets a chance to do what it can do best, which is commerce, industry, and development.
How much do you think the geopolitical situation, the conflict, is taking a toll on growth in this region?
I think a lot, because there is a lot of signaling also that happens, and there are a lot of intra-regional trade that has been disrupted significantly. So I think it has a lot of effect. again, we are a very open economies in the GCC, and trade with China is the largest. So this is not a regional issue. But nonetheless, the potential that was sitting there waiting to be cultivated is evaporating with all of these conflicts and this level of uncertainty.
We're lucky to have Tony on the panel from Africa as one of the biggest investors and philanthropists in the continent, also the chair of a bank. So how does all of this impact what's happening there and the growth prospects?
First is, I'd like to commend the organizers of this event. I'm happy to be here and to be sitting with great ladies and men like this. I want to bring an African perspective to the conversation. And I'd like to start with the demographics on the continent. We have currently about 1.5 billion people, and it's projected to double in the next 20 years. So that would be 2.5 billion people. The median age in Africa is 19 years, 19. Median age in the most populous country in the world, India, is 28. And the median age in America and in China is 35. So you can see the picture. And it's projected that 1 in every 3 young citizens of the world will live in Africa in 2050. So what we see here is, as an investor, I see huge market and opportunities. As a philanthropist and a realist, I see a big challenge. Poverty is far outgrowing wealth creation on the continent. We've seen that leading to intolerance. We've seen political instability on the continent. And so when I look at all of this, what could become a huge market for the world and opportunity for investors can actually become a global disaster. And we all must begin to address some of these issues. The big issue here is how do we keep these young ones in Africa employed so that they don't become embarrassing or a risk to the rest of the world. This morning, we're hearing about AI and the massive data required in AI, massive data and also massive electricity. And I listened to His Excellency speak not long ago, talking about mega gigawatts of electricity. But on the African continent, over 50% of the continent do not have access to electricity. Without access to electricity, Africa cannot industrialize. Without industrialization on the continent, jobs will not be created. So it's going to be a challenge. And for me, as an investor, as a philanthropist, as a realist, this is what I think about always. And this is what keeps me up at night. And when I get opportunity like this kind of issue I like to put on the table. And that's why I said I wanted to start with an African perspective to the conversation. This is what I see.
Yeah, I mean, the numbers, the demographic numbers are staggering. I think, Makura, what is the median age in Japan right now? You have the opposite situation, I think it's safe to say. We've been excited from an economic perspective on Japan lately, animal spirits and all, but then you started raising rates and the yen stopped weakening, so what's happening now?
Okay, thank you, Sarah, and thank you for having me this morning. And Japan is always creating a lot of unique situations. And let me just start with the macroeconomic conditions. This year and perhaps next year, we are going to see the around 1% growth. It's still growing. It's not robust enough, but it's growing. But at the same time, more important element is inflation. This year, perhaps next year as well, the around 2% inflation. This is really the significant change compared with last 30 years or so. And also, once we confirm the wage increases we will see in the next year, it's going to be finally the sign of end of deflationary environment in Japan. For example, last year there was over 3% wage hike, and this year about 5%. And perhaps we anticipated more than 4% the wage increase, at least for the next year. Once we confirm that, this is the end of the deflation in Japan. So basically, it's not a robust area, but it's very positive move. And I basically agree with Neil in terms of there is the positive moves and the positive development opportunities in Asia, including Japan. In Japan specifically, there are two things, two changes taking place at the same time. First, the household and the consumer side, they are now slowly and steadily moving the savings to investment. For example, the government started the new NISA, which is tax incentivized investment account, starting in January this year. Since then, what we are seeing is almost 4 times more investment through NISA account compared to the last year. And this is a significant move as Japanese consumers have more than 1,000 billion yen of savings, cash and deposit. And that's one significant moves. And the second one is, as Neil described, we are seeing all over in Asia, but in particular Japan. There is because of the corporate, the governance reform, and a lot of unwinding, unleashing of joint holding of the shareholders, and a lot of activists, or I should say, the engagement shareholders are coming, and all the boardrooms is seriously, taking a look at the balance sheet and the return. So what we're seeing right now is for the last several years and continues to be the next several years, tons of corporate actions. That include M&A and divestiture of non-core businesses, and also making the 100% of core subsidiaries into the entire combined balance sheet, and also there is a sense of privatization coming from the pressure, coming from the market, and so we're seeing a little bit, the activities. That's very positive, and there are a lot of transactions. We work together with all those gentlemen.
Yes.
Or lady. So that's a sort of the picture of Japan. Even after the election of last Sunday.
After the election.
I believe so.
We have Bill here from Standard Chartered, which is a very global bank, but since you're based in the UK and closest proximity to Europe, you can give us the health check of Europe. Is Europe growing?
Not very fast. First of all, thanks for having me. No, not very fast. But European companies are growing, and it's interesting to see where they're growing. The European companies have invested for a long time in Asia. They've invested in the Middle East, and they're investing in Africa very, very actively. So the growth in corporate profits is coming substantially from the markets outside of Europe. Now, that's a structural problem because, of course, the home base is Europe. Economic growth is slow. Political fragmentation is real. But we're seeing a number of European countries, I'll say including the United Kingdom, who have governments, while dysfunctional in some way in their making, are having quite a big impact in terms of execution of some reform programs on the ground, or maybe said another way, letting business get on with it and make the best of it. So while Europe has been a real laggard in global growth, I think we have to take a step back as well and say the global economy is in really good shape, right? We're growing above what the economists say is potential. We've got multiple engines. The US is absolutely powering. This region is powering. Indian subcontinent is powering. Africa is growing above trend, right? And it doesn't feel it at the bottom of the pecking order, right? But Africa is growing. And Europe is the laggard, for sure. But with European ingenuity, innovation, ability to branch out and invest in the rest of the world, I'm quite optimistic that Europe will find a way to get out of its own way over time.
What about the UK? Outgrowing Europe?
The UK has by some measures, has actually performed reasonably well. I mean, the UK has not fully recovered from the financial crisis. The economy was overweight financial services and is now shifting into life sciences, defense, unfortunately, I think we could probably say, as it remains a very important financial center. So I think the UK is going to be fine. This government's got a credible plan. We'll hear what the Chancellor has to say with her budget this week. But yeah, it's a very resilient place. Like Noel Quinn said earlier, HSBC was around for 160 years. The UK's been around even longer than that, and it's survived through that period. It will survive again.
How long has Standard Chartered been around?
I'm a little bit longer, but I don't want to brag. It's 100.
I thought that's where you were going with
It's 170 years, but since you asked, but I wouldn't have raised it otherwise.
Jenny, you are building quite an empire over at Franklin Templeton. I don't. How many investment managers do you have now? Like 20?
We probably have 11 branded.
Okay, 11. I saw 19 somewhere. But what do you see right now from investors? And I am curious if you've been investing a lot around alts and private markets and how you see that reshaping the economy in the U.S. and globally.
Well, it's interesting. I was thinking through, this question of how many IPOs are we going to start seeing more? Let's face it, when cash was free, it was easy to be a brilliant private equity manager. It was easy to do well in most investments. Times have changed, so it's a little bit more difficult. But I think there's a necessary, if you think about private equity sitting next to a public company, in today's environment where companies need to invest in things like AI, and there's going to be a lot of investment that doesn't have immediate returns, or maybe you're a company that needs to adjust your supply chain, and so you have to make an investment in that which will take time to pay off. The challenge of a public company is there is so much focus on quarterly earnings that it can be difficult to do those kind of investments if they take a couple of years to play out. And actually R&D for healthcare companies and others. We invested in a company that was, it was a platform that has about $3 trillion in client assets on it. They needed to invest in the technology to redo the platform, so they were taken private, but ultimately private equity companies have to go public. So there's almost going to be this cycle, I think, of, it used to be just you went venture, private equity, and then public, but I think there's going to be an opportunity for a necessary opportunity for public companies to be taken private, to do those investments and adjustments, and then come back, and it'll start to be a normal cycle. And then, of course, private credit, I think, the banks, I've got a lot of bank CEOs here, just the capital requirements are such that it's just hard to lend like they've had to lend, and so that's a much bigger area. So we looked at it and said, we need to be able to offer both public and private together, and that's been our focus of growth.
So, I have Harvey and Mark on that, but Mark, so reshaping of the economy through private credit, and how is that happening?
I don't think it reshapes the economy. I think we have to, look, the U.S. capital markets are the envy of the world. We raise 50% of the world's capital. We have a capital market where bank lending is 30%, and investors supply the balance of credit. So credit in any economy comes from one of two places, the bank marketplace or the investment marketplace. There's no third choice. And so in the US, we've found that balance, and we will continue to see convergence, cooperation, partnerships between the bank sector and the private credit sector, between public markets and private markets. And I think there's going to be a blur. We will not know in the investment grade landscape the difference between public and private 18 months from now. We won't even care. It's going to be the same types of companies, the same ratings, the same size, and ultimately the same liquidity or lack thereof. So I think this is a piece of a puzzle. It's not the puzzle. Private, at the end of the day, is going to be a very small piece, but a necessary piece of what needs to happen.
I guess I just wonder sometimes if some of the resilience that we've been talking about in places like the US has been because private credit, private lending has stepped in and played a big role. And so maybe we haven't seen as much distress or problems as we would have ordinarily.
Well, first, I agree with what Mark said in terms of the trends. I don't agree with Jenny, because now I have to go back to my firm and explain to all my geniuses that they're still geniuses. 'Cause I think Jenny might have hurt their feelings. But, this transition to private capital, this is not a new phenomenon. This started 30 years ago with private equity and then venture capital. And all that's happened is as these companies have elected to stay private, it was quite natural for private credit to come in, plus bank regulation. But I think this is about just the efficient delivery of capital. Capital is like water coming down a hill. It will find its path. Sometimes it gets stuck, but it will find its most efficient path. And if the most efficient path is a private capital solution, a public capital solution, or a blended solution, companies need the capital. It is the fuel for growth, and we will figure out how to provide them with the best capital solution. In terms of your question around the nature of the markets, the resiliency of the markets, this is a question that comes up all the time. I think you have to really differentiate between idiosyncratic risk and systemic risk. And the private capital markets, because of the liability structure, the limited leverage, the lack of concentration, and the fact that there's no interconnectivity really does not have the characteristics that really fueled the financial crisis back in 2008. Idiosyncratic risk is the nature of all capital commitment, whether it's private equity or whether it's credit, whether it's investment grade or not. And so that is about making smart marginal decisions about how you deploy that capital. But I think these conversations kind of get blurred and they should be quite separate.
Jane, is it a threat to the big banks, the boom in private credit, or an opportunity?
There's clearly an opportunity for a win-win, and I think that's what Mark and I have seen the relationship Apollo has with Citi, and that comes from our perspective. We serve clients in multiple different products and capabilities and have a strong origination capability. We can give our clients a choice. Do they want to go into a private asset vehicle? Do they want to go into the public markets? And I think that's where we saw the win-win with Apollo, that we can bring that together as well as their deep asset capabilities. So the main piece for us is the client wins.
The client wins. I thought you guys were just saying that to be nice on the panel together, but actual partnership. As we think about the longer term, and some of these were referenced already, big changes going to affect how you all do business, what you see in the economy, what you see from investors, and AI really, I think, is at the top of the list and also at the top of all of our minds. It's a huge topic here. And Jenny, I know you're very excited about it, so I'm curious, is it because you think it's going to transform financial services, the economy, or what?
I think it's going to transform
Everything.
Everything. And I mean, look, today, anytime you have a new technology, the first things people do, the first investment opportunities are the picks and shovels, right? That's what we saw in the Magnificent Seven, which, by the way, when we think about how well the market performed, the Magnificent Seven had 450% increase in earnings from 2020. The rest of the S&P 500 had a 26% increase in earnings, right? So it's a big difference. So that's the picks and shovels. Now what's happening is
That's NVIDIA, right?
What's that?
That's NVIDIA.
Well, it's NVIDIA, it was Microsoft, it's Google. I mean, so it's all it's the cloud service providers too. But the rest of the world is trying to figure out what to do with it. And I say it's like a really smart intern. As a matter of fact, Bill, when we were doing a little research on the members to find out something, it said that you were a concert saxophonist. Apparently you're not. But if you actually go through the sourcing, it has this logic. So it can
Wait,
end
are you
up
or
in
are you not?
hallucinations.
You're not.
I can confirm that I am not.
He's not. But the point, on the other hand, we're doing things like RFPs take us something like 8 hours or 18 hours to put together, and they're finding they can do it in 15 minutes for the first draft. Think about that kind of opportunity and savings. So the first things is you start to improve what you do today. But I think Ruth made the point, then people start to become proficient, understand the technology, and that's when you get the big breakthroughs. And it is going to happen in every industry, and the ones that figure it out are going to rocket ship past the rest of their sector. And so that's why I think it's transformative.
Do you think it's overhyped, David?
I don't think the ability for the technology change to change the way we all operate is overhyped. That's a different comment than a debate on the value of this and the value of that at this moment in time. But this is a journey we've been on for a long time. I'm listening to Jenny talk about changes in the way people work. I go back to 40 years ago when I started. If you wanted to do a common stock comparison, you had to go to the library, and it took 4 to 6 hours. It doesn't mean we don't have a lot of smart people doing a lot of smart things, around our business. This is a further acceleration of trends that have been embedded for a very long time. I think the productivity gains, especially in businesses like ours, are going to be enormous. I think the challenge for people running, big significant businesses with these technologies is it's very interesting to create tools that make people it's very easy to create tools that make people more productive. Can you fundamentally change your operating processes in your business? That is much, much harder. And, that's something that I think is going to be difficult and takes a long, long time. But generally speaking, big tailwind, something to be very optimistic about, something that's going to improve productivity, something that's going to help with growth. And how people can employ it, take advantage of it. You don't necessarily have to be first, but you've got to make sure you make smart decisions. It's expensive, and so you've got to be prudent about your investments. There's definitely going to be capital that's deployed that doesn't get great returns. But I'm quite constructive on the opportunity set to drive more economic growth.
What about your own company? I mean, your biggest cost is labor, right? Your stock's at a record high. That's obviously your performance only and the capital markets. But I do wonder how much is optimism baked in around what a bank can do when it comes to savings and profitability around AI.
I mean, you know, look, little Goldman Sachs trades at 12 times earnings. You know, I'd like to get the market multiple.
You're at a record and you're complaining.
I'd like to get the market multiple. I wouldn't say that the optimism around financial services broadly and kind of a movement in the multiples on the large bank stocks is geared to an AI optimism. I think there's a capital markets tailwind, you know, for sure. And I think also we're 15 years past the financial crisis. I think these large institutions have changed significantly. They have a different kind of durability. They have different earnings streams that are much, much more diverse. And, you know, I think those things are all positive in that context. How will we employ this? We will employ this stuff again, creating tools to make our people more productive. We can do that. We know how to do that. Changing operating processes, significant operating processes in businesses, that's more difficult. And that's not just our industry. I think that's going to be true across all industries. And there are going to be some very interesting opportunities that come out of that.
Well, speaking of opportunities, as a major VC investor in Asia, Neil, how are you pursuing the AI trend? But first of all, how much of it is your investments are related to AI?
That's right. Yeah, I think that it's going to have a very long-term, profound impact on our industry. Obviously, you know, even 10 years ago, we're starting to see data analytics has been used, leveraging the last generation of AI. But this time, I think the general AI is really a paradigm shift. I mean, I would be surprised any people here are now using, GPT or GPT, equivalent. And I agree with David that it's obviously going to dramatically improve our productivity. But I think probably more than that, if you look at our industry, it's about knowledge workers, right? And traditionally everyone had its own knowledge, but now with general AI, there's a chance that we can develop beyond that. Think about it. Each of us should actually have a financial service agent. Each of us should have an AI agent for us. And then as a firm, you got this collective of agent, which has its different information and knowledge. And I think it's the first time in the history that financial service company has the ability to have this wisdom, the information collected in the one sort of piece. And that could be shared among the team members and also passed on from one generation to the other. So a firm is not only just build on balance sheet and brand, all that, but also that a firm, a financial service firm, is able to have transitioned, transform its wisdom from one generation to the other and build a long-lasting organizations. I think this is great. And specifically for the venture capital industry, I feel that we have something more to do because we're in the private investment sector, not like a public, whereby every information is more or less available to all, right? So, look ourselves. We invest over 100, 500 companies over the world, last 19 years. And there are many companies failed. These are in the seed stage, venture stage, but there's a few become extremely successful, and many become unicorn, right? So when you get this private data, you should be able to use the tools to analyzing what makes a successful investment and what makes a successful company, right? There's a lot of sort of, signs or, pattern recognition you can use, you can able to find out, use the general AI tools. I think this is fascinating. Everyone is at a very early stage of exploring that, but I do think this is actually not just helping us to process information, but potentially helping us to do a better job, especially when it comes down to early stage investment, and find the next great companies using that, pattern recognitions with, general AI as its core foundations.
Well, very appropriately, we have our AI intervention here. So let's hear it.
Despite AI's $2.7 trillion projected economic impact by 2030, Gartner research indicates 85% of AI projects still fail to deliver. This staggering disconnect exposes a dangerous chasm between AI's promise and its practical implementation in most businesses.
Which is why I asked about the disconnect. So, Your Excellency, you've been focused on sort of the pace of all this and what regulatory framework should look like as this technology booms.
Well, no one can afford not to look at AI. That goes without saying. That's not a revelation. But I think from where Tony was speaking and I have 57 member countries, 25 of them are least developed countries, 18 of them are fragile economies. So our challenges are not really to adopt the AI per se, but really to do something about resuscitating growth in those countries. Some of them have extremely high levels of debt that they can ill afford how to use it. They have low level of knowledge in terms of execution of projects that will accelerate economic development, leading to an AI aspiration afterwards. And therefore, what we need really is to deal with that fragility and to bring back some resilience for those countries. We are lucky at the Islamic Development Bank that being a development institution from the South, that we understand and we deal with those issues one by one. This year, we are going to close 2024 by lending about $5 billion to those member countries in Africa and Central Asia and in the MENA region. That is 3 times what we did in 2020. So we're really gearing up to support those member countries, and they really are doing well with that funding that is happening. So that's not to say that the formula doesn't require good economic policy making in those countries in the sense of structural adjustment, predictable monetary and fiscal policies, and transparency that will really bring in not only the domestic investors, but the foreign investors. But the promise of those countries is really great. We just need to see how can we bring about sufficient support that will really boost their engines to a level of growth and development. In the luckier members, like as I said in the GCC, they just need to stay the course because they're really doing very well in micro policy and on the macro policy, meaning the fiscal stability and the monetary stability. Those are very important. The signals coming from governments can make all the difference.
Yeah, I imagine long-term structural issues that you can relate to. We hit a lot on AI and digitization. One of the others that I think a number of you are thinking about is this idea of deglobalization, or a different kind of globalization where there's been more friendshoring and tariffs and geopolitical conflicts. And I am curious how it impacts the trajectory for Africa.
First, Your Excellency, I think you hit the nail totally on the head. When we have conversations, different regions of the world have different priorities. And that's why I said before that I bring African perspective to the conversation here. If we talk about AI, the bank I created, which operates in 4 continents, serving over 50 million customers, in 2018, January, actually launched its AI virtual banker called Leo then. And in fact, Mark Zuckerberg announced it in May that same year in Silicon Valley when they had the F8 Facebook conference. But the point is, the demography that I spoke about before, we have, for instance, 50 million customers. We can easily grow that to 100 million customers and beyond. But we need to think of the capacity to serve the 100 million customers and even the hundreds or tens of millions of customers who do not have access to financial services on the continent. We need to think of the capital that we need to help drive the infrastructure deficit we have on the continent. We need to think of how we capacitize the private sector to create jobs that we need for the young. The median age is 19. So what I see clearly is the priorities are different. The priority for Africa at this point in time is how do we mobilize the much needed private capital, in fact, capital to the continent to help fund infrastructure development. Access to electricity is the biggest challenge we have on the continent. If we fix access to electricity, our young girls will be more engaged, intolerance will go down, poverty will go down, and political instability and social instability we have on the continent will go down. And then we can begin the journey. So to me, I like His Excellency, when you were speaking, I was nodding because he hit the nail so badly, and I commend the efforts of your agency, and we need to do more to help support the Global South, in particular, those that are struggling to find their feet.
Well, you have a few friends around the table that can maybe invest and help you out there.
We continue the conversation outside this place.
Yes, good. Can't settle everything at this table. We have just like seconds left, so I want to hear from everybody in like 2 words what the biggest long-term issue you think that global economy is going to face, or how a biggest long-term issue for your business, Ron. And I do wonder if this whole fractured world fits in.
Well, very quickly,
Yeah.
globalization is one.
Yeah.
Everybody in this room, I would venture, has benefited from globalization over the last 30, 40 years. And that has, the growth of globalization has ceased. We're now starting to see that reverse. That is one threat. Decarbonization, I think, is both a threat and an opportunity. I mean, the point here that moving forward requires electricity, but there's a lot of investment that's going to be required here, both in terms of mitigation of carbon, but also adaptation for the climate change that we're seeing. That will pose inflationary pressures. And then thirdly, this is all happening at a time where debt levels are very, very high. So to me, and we don't talk about this enough, the fact that we're at 93% of GDP for global debt is a real risk that we have to think about at a time when we're not in a global recession.
Okay, Ted.
The end of financial repression of zero interest rates and zero inflation, that era is over. Interest rates will be higher, will be challenged around the world, and the end of history. Geopolitics are back and will be part of the challenge for decades to come.
Jane, do you have a quickie?
Resiliency is going to be critical, probably emotional, as well as the more pragmatic side of it. Adaptability, as we've talked about. I'd also say the criticality of engagement. Think about the COVID years, we're all separated, how important as some of this fragmentation occurs, that the dialogue continues, and that's going to require some new muscles.
Last word to you, Makoro. Biggest worry for you?
Sure. As I agree with Ron, actually, level of the debt on a global basis is the biggest concern of myself. If we take a look at the, the level of debt level of private sector, the private sector debt to GDP currently is around 150%. And this is a similar level of the Lehman crisis level, even lower in the US market is concerned. But because of the lot of regulation has been building up since the Lehman shock, so level of the private debt is not, the unhealthy, to my knowledge. But during that period, governmental debt to GDP has significantly, increased. So how those, government debt and could be sustained?
Yes.
And is also this situation is also taking place in Japan as well. Every elections we are seeing in the market, there is a pressure on the fiscal spending. And, I don't know how they, control those debt level of the government under the, tend to be the populistic, move. So that's really concerns me, how we could sustain.
Okay, we're over time. We need another 3 hours for this conversation, but I thank you all for your participation, and I'm glad we got a nice 12-person roundtable going on all the big issues. Thank you. Please turn your attention to the screen.